The silver breakpoint, when trust melts faster than metal. 1. The rumbling in the metals market. Something strange just happened in the silver market. Short interest exploded. Several major bullion dealers halted trading. And even the biggest banks, yes, the same ones fined nearly $1 billion for manipulating precious metals, seem to be losing control of the game they designed. So what does that actually mean? It means the paper promises that kept silver prices calm might finally be cracking. One of India's largest bullion firms reportedly ran out of silver. Australia's Perth Mint had technical issues. North American dealers froze trades. At first, it looked like coincidence. But 3 continents, 1 pattern, that's not coincidence. That's contagion. Footnote. Global bullion shortages across major markets suggest a structural failure in the paper-to-physical silver system. 2. The bankers who broke their own game. J.P. Morgan once paid over $920 million in fines for manipulating precious metals. Why would a global bank suppress gold and silver? Easy. When those prices rise, people start distrusting paper money. And when trust goes, so do deposits. Banks don't like that. So they managed prices with futures contracts and derivatives. The plan worked, for a while. But like all suppression schemes, it eventually runs out of rope. The cost of borrowing physical silver has spiked over 1,000%. Dealers can't deliver metal. Futures markets are bending under pressure. So what does that actually mean? It means price control only works until the real stuff runs out. Footnote. Decades of price suppression created a leveraged paper market now buckling under genuine physical demand. 3. Central banks blink first. For 2 decades, central banks have been net buyers of gold. But whispers are emerging, silver may join official reserves again. That hasn't happened in over 20 years. If true, it would mark a turning point, governments quietly admitting that fiat alone can't hold confidence. Silver, once treated like an industrial leftover, could suddenly become strategic again. So what does that actually mean? It means the referees of money are quietly hoarding the hard stuff, while the public argues about interest rates. Footnote. Central banks shifting toward physical metals signals weakening faith in fiat stability. 4. Gold's rally in the shadow of history. Gold just hit $4,150 an ounce, a new all-time high. Silver nearly doubled in 6 weeks. The pattern mirrors the early 1920s Weimar melt-up, when currency collapsed and gold measured panic. After years of quiet consolidation, precious metals are now screaming that something deeper is broken. Massive deficits, near-zero interest rates, and endless money creation, all the same ingredients that triggered every monetary reset in history. So what does that actually mean? It means the market smells inflationary fire long before the headlines do. Footnote. Rapid rallies in gold and silver historically precede systemic monetary stress and loss of confidence in fiat systems. 5. The supply shock nobody expected. Lease rates for silver, the cost to borrow metal, have gone vertical. Some call it a meltdown. A 1-month lease jumped to 35%. Physical bullion vanished from dealer inventories. Exchange-traded funds halted redemptions. And yet, the official narrative says technical issues. Sure. If futures markets begin backwardating, when near-term prices exceed future contracts, that's the alarm bell. It means physical silver is worth more now than later. Translation, shortage confirmed. So what does that actually mean? It means paper silver may soon be as fictional as trust itself. Footnote. Exploding lease rates and potential backwardation confirm critical physical shortages within the silver market. 6. The billion-dollar question. J.P. Morgan just announced a $1.5 trillion investment in 27 critical industries, on the very day the silver market froze. Odd timing. The bank only holds $1.1 trillion in liquid assets. The math doesn't math. Maybe coincidence. Maybe cover. After all, when the same institution fined for manipulation suddenly declares patriotic investment while markets melt, skepticism isn't conspiracy, it's self-defense. So what does that actually mean? It means that when reality doesn't add up, follow the timing, not the press release. Footnote. Contradictory financial disclosures during commodity crises often signal strategic repositioning, not coincidence. 7. The fourth turning, again. Every 80 years or so, monetary systems collapse under their own weight. We call it reset. The 1930s had one. The 1970s had another. Now, with global debt maxed, deficits ballooning, and trust thinning, it's happening again. People once mocked gold bugs. Now central banks are the biggest buyers. The same banks that laughed at silver are trying to restock it. And ordinary investors? They're realizing that safe assets aren't always safe, especially when you can't withdraw them. So what does that actually mean? It means the reset isn't coming. It's here. Footnote. Recurring 80-year financial cycles reflect structural limits of debt-based monetary systems and the eventual flight to hard assets.